So if you break your arm, right, the x-ray shows this jagged white line and the doctor points right to it. It's, engineering precision.
Right, it's obvious.
Exactly. But if you try to diagnose the Philippine value-added tax system using that same logic,
Right.
the x-ray machine it basically bursts into flames.
Oh, absolutely.
It is murky, it's full of exceptions, and man, it is completely unforgiving.
Which is exactly why examiners love to test it. I mean, welcome to this special ICPA Review Radio edition of the Deep Dive, right?
Well,
We are looking at sections 105 through 112 of the tax code today.
yeah, the heavy hitters.
Oh, definitely. For
Oh.
anyone gearing up for the CPA board exam, VAT it's the ultimate trap. It blends this really strict memorization with these cascading computational problems.
Right, where if you mess up one thing early on.
Exactly. If you misclassify a single transaction at step 1, well, your final answer at step 10 is completely wrong. And you know the examiners will have that wrong answer sitting right there as choice letter C.
Oh, they always do. They know exactly how you're going to mess up. So we are essentially doing tax triage today on the deep dive. We're going to break down the mechanics, the hidden traps, and I think most importantly, the logic behind the rules.
Yeah, the why behind it.
Right, so you aren't just memorizing blind, because to survive VA questions, you really have to understand the core mechanism. I always used to think of VAT as a relay race.
Okay, a relay race.
Yeah, where the tax is the baton, right? And it gets passed from the manufacturer to the wholesaler over to the retailer until finally the final consumer is just stuck holding it at the finish line.
That's a good way to look at it. The relay race metaphor definitely explains who ultimately bears the economic burden.
The consumer.
Right, you and me at the grocery store.
Hmm.
But it sort of fails to explain the actual computation you have to perform on the exam.
Ah, okay, fair point.
A better way to visualize VAT for your computations when you're actually sitting there with your calculator is a bucket of water.
A bucket of water. Okay, I'm tracking.
Yeah. So every time a VAT-registered business buys materials, they pay input tax. Think of that as water they're forced to pour into the government's bucket.
Okay.
But then, when they sell their finished product, they collect output tax from their customer. So they get to scoop their initial water back out of that bucket, and they only give the government the net difference.
Output tax minus input tax.
Exactly. Output minus input.
So the BIR only cares about the net difference at the end of the day.
Right.
That makes total sense. But before we even get to the math, the exam is going to test you on whether a transaction even qualifies to be in that bucket in the first place.
100%. The classification phase.
Yeah, because Section 105 says you're liable if you sell goods or services, quote, in the course of trade or business.
Yes.
And the trap here, and I know I fell for this when I was reviewing, is that you naturally associate the word business with making a profit.
Of course. That's the layperson's definition.
Right. So if a nonprofit hospital opened the pharmacy, or say a government agency sells off some surplus equipment, they aren't profit seeking. So do they escape VAT?
The tax code specifically anticipates that assumption and just completely crushes it.
Ouch.
Yeah. Nonprofits and government entities are absolutely liable for VAT if they engage in commercial activities.
Really? So the nonprofit status doesn't protect them from VAT?
Not at all. And think about the logic behind it, because that helps you remember it on exam day. If a private, for-profit pharmacy has to charge 12% VAT on a bottle of vitamins,
Okay.
but the nonprofit hospital's pharmacy next door doesn't have to charge that 12%, well, the nonprofit can artificially undercut the market.
Oh, wow. Yeah, because their prices would instantly be 12% cheaper.
Exactly. The government applies VAT to maintain a level playing field across the board, completely, regardless of how the entity actually uses its net income.
Leveling the playing field, that why makes it so much easier to remember. You're not just memorizing a rule, you understand the market mechanics.
Right.
But wait, what about the rule of regularity? Usually to be considered a business, you have to be doing something regularly, right?
Normally, yes.
Yet there is this glaring exception for non-resident foreign persons. Like, say a tech consultant flies in from Singapore, gives one single lecture in Manila for some massive fee, and then flies out the next day.
Right.
There is zero regularity there. It's a one-off thing.
And the BIR taxes that service anyway.
Really, even just for one day.
Even for one day. The law explicitly states that for non-resident foreign persons rendering services in the Philippines, the rule of regularity is completely ignored.
Ignored. Wow.
Yeah, and again, look at the underlying economic logic here. Say you've got a local Filipino consultant who gives seminars for a living.
Yeah.
They have to register. They have to charge 12% VAT. Right.
Because it's their regular business.
Exactly. Now, if a foreign consultant could fly in, do a one-off gig, completely tax-free, and then leave, local businesses would essentially be penalized just for being local.
So the foreign guy would be cheaper just because he doesn't live here?
Exactly. So the government protects the local tax base by taxing the foreigner's one-time service.
So for you listening, if you see a foreign consultant or an international service provider in a multiple choice question, just completely ignore the word regularity.
Just tax it.
Just tax it. I love that.
Yeah.
Okay, so now, assuming we have established that someone is liable, we need to know what value to actually multiply that 12% by.
The tax base.
Right, the tax base. Sections 106 and 108 lay this out, and examiners will absolutely try to trip you up on the terminology here. We have gross selling price for goods and then gross receipts for services.
Two very different concepts.
Yeah, let's look at goods first. Gross selling price excludes the VAT itself, obviously, because you don't tax a tax. But what about other taxes?
Okay, this is a huge one. If the good has an excise tax, so think things like automobiles, alcohol, petroleum, that excise tax is permanently baked into the gross selling price before you compute the VAT.
Wait, so it forms part of the taxable value?
Yes, it forms part of the value. The exam might give you the raw cost of a car, and then they'll give you a separate figure for the excise tax.
To try and trick you into ignoring it.
Exactly. You have to add them together first, get that total sum, and then apply the 12%.
Because VAT is a tax on the total value, and the excise tax legally increased the value of that car before it was even sold.
Precisely.
Okay, so that's goods, add the excise tax. But for services, we use gross receipts. And the code says this is based on cash or its equivalent, quote, actually or constructively received.
Yes.
We really need to unpack constructively received because to a stressed out candidate, that just sounds like legal jargon designed to confuse you.
It does sound intimidating, but constructive receipt just means you have the power to control the money, even if it isn't physically sitting in your bank account yet.
Okay, give me an example.
Sure. Imagine you finish an auditing engagement on, say, December 30th.
Right.
The client leaves a check on your desk that afternoon. But you decide, you know what, I'm just going to leave it there and go celebrate New Year's.
Sounds like a good plan.
Right. And you don't actually deposit it until January 2nd. The BIR says you constructively received that income in December.
Because you could have deposited it.
Exactly. Because you had the unrestricted right to take it to the bank.
So it's taxed in the fourth quarter of the old year, not the first quarter of the new year.
Yes. And that timing difference is prime bait for a multiple choice question.
Oh, I can see it now. They'll give you all the January dates to throw you off. And this also includes advance payments, right? Like if I get a 50% down payment in November for a construction job, I won't even break ground on until February.
You tax the advance payment in November.
Even though I haven't done any work yet.
Even though you haven't lifted a finger. For services, it is all about when the cash flows in, not when the work is actually performed.
Which brings up a really fascinating contradiction, actually. We just said VAT triggers when cash flows in, but the BIR also taxes situations where absolutely no money changes hands at all.
Yes. Section 106B.
The transactions deemed sale. This always blew my mind. If I own a VAT-registered appliance store, right, and I take a flat-screen TV off my own shelf and I go mount it in my own living room, the BIR isn't in my house. Why do they care about a TV I just gave to myself?
They care because of tax leakage.
Tax leakage.
Yeah. Think back to the bucket. When you bought that TV from the manufacturer for your store's inventory, you paid input tax.
Right.
And you claimed a credit for it. You essentially got a tax discount from the government based on this promise that you were going to sell it to a customer and collect output tax for them later.
Okay, yeah. I told them I was going to sell it.
Exactly. So if you just consume it yourself, or say you give it to your shareholders as dividends, or use it to pay off a creditor, the government loses the output tax they were promised.
They gave me the credit, but I didn't hold up my end of the bargain.
Exactly. So they deem it a sale to force you to pay up that missing output tax.
You can't claim the input credit and then just make the good magically disappear?
Nope. The BIR will find it.
That logic applies to closing a business too, right? When you retire from business, any inventory left over is deemed sold.
Yes, all of it.
But the trickiest one here, I mean, the one examiners just absolutely feast on, is the 60-day rule for consignment.
Oh, consignment is a massive loophole if it's left unchecked.
How so?
Well, if you manufacture shoes and you place them in a department store on consignment, you haven't technically sold them yet. The department store is just holding them for you.
Right, they're just on display.
Exactly. So without a time limit, businesses could just park their inventory in each other's warehouses indefinitely, call it consignment, and just never pay the output tax.
Oh, I see. Just indefinitely delaying the tax. So the government put a ticking clock on it.
A very strict ticking clock, exactly 60 days.
60 days.
If those consigned goods aren't sold to a real customer within 60 days, the law deems them sold by you on day 61.
Day 61.
Yeah. And in an exam problem, they will tell you goods were consigned on March 1st, and they're still sitting there 90 days later.
Right, and they'll ask for the VAT payable.
Yes. And candidates will read that, they'll see no actual sale happen, and they'll compute zero output V8. You have to recognize that on day 61, a deemed sale occurred, and you owe 12% on that value.
Man, circle day 61 in your mental notes, everyone listening. Okay, so once we figure out if something is legally considered a sale, how do we price the tax on it?
That's where things get really fun.
Yeah, that's where we run into what I call the three-headed monster of VAT, 12%, zero-rated, and exempt.
This is the absolute critical junction for any computational problem. Both 12% and zero-rated transactions are technically legally taxable sales.
Wait, zero-rated is a taxable sale?
Yes, it just happens to be taxed at a mathematical rate of 0.
Okay, but why does that terminology matter?
Because to claim an input tax credit, you must be making taxable sales.
Okay, let me walk through this mechanically just to make sure I have it and to help everyone visualizing this.
Sure, go ahead.
If I am an exporter, which is a zero-rated transaction, I buy wood for 100 pesos, and I pay 12 pesos in input VAT, the lumber guy. I make a chair, I sell it to Japan, I charge the Japanese buyer 0% output VAT.
Right.
But because my sale is technically taxable, I can go to the BIR and say, hey, I paid 12 pesos in input VAT, but I have no output VAT to offset it against. And the BIR actually gives me a refund for the 12 pesos.
That is the holy grail for a seller. You recover your tax costs completely.
Okay.
But now compare that to an exempt transaction under Section 109. If you are selling an exempt good, you do not charge output VAT.
Right.
But crucially, because you are not making a taxable sale, you are legally barred from claiming any input tax credits.
Oh, so that 12 pesos I paid for the wood.
You can't get it back. It's gone. It becomes an expense. It just eats directly into your profit margin.
So the exam will present a list of transactions, and if you accidentally categorize a zero-rated export as an exempt sale, your input tax computation will be entirely wrong.
Exactly. You'll subtract an input tax you aren't legally allowed to subtract.
Which means we need to look really closely at Section 109, the exempt transactions. The granddaddy of them all is the original state rule for agricultural and marine food products.
Yes, very highly tested.
But the definition of original state is surprisingly broad.
It has to be broad to protect the food supply chain. I mean, the law exempts basic food products to keep the population fed cheaply.
Right.
But a fisherman in Mindanao can't just teleport his catch to a market in Manila.
Right, it would spoil.
Exactly. He has to freeze it, dry it, or salt it just to preserve it for the journey.
Yeah.
If the BIR said salting is processing, so it's taxable, the cost of basic preserved food would skyrocket overnight.
It would ruin the whole point of the exemption.
Exactly. So simple processes of preparation or preservation, freezing, drying, salting, broiling, roasting, smoking, all of that keeps a product in its legally original state.
Okay, so a roasted, salted fish is exempt.
Yes.
But what about boiling?
Boiling is just applying heat. It's exempt.
Okay, but when does it become taxable?
The moment you start adding complex chemicals or encasing it in a tin can with preservatives like canned sardines, it becomes a processed good, and bam, it is subject to the 12% VAT.
Okay, so canning is the trigger. Speaking of processing, let's talk about the sugar laser test.
Oh, the polarimeter. Yes.
Because examiners love testing raw versus refined sugar. The law exempts raw sugar, but how does the exam differentiate them? Do they just say brown and white?
No, it relies on a literal chemistry test. They use a polarimeter, which basically shines polarized light through a sugar solution to measure the concentration of sucrose.
It's so scientific for a tax exam.
It is. And the magic number in the tax code that you have to memorize is 99.5 degrees.
99.5.
If the polarimeter reading is less than 99.5 degrees, it is legally classified as raw sugar, and it is exempt.
Okay.
But the moment it hits 99.5 or higher, it's legally refined sugar, and it gets hit with the 12% VAT.
99.5 degrees. That is a hard threshold you just have to drill into your head.
Absolutely.
You also have to memorize the social exemptions. educational and medical services. But there are caveats attached to both of those that examiners love to exploit.
Right. For education, it's not just any school. The school must be duly accredited by DepEd, CHE, or TESTA.
Ah, so a rogue, unaccredited review center cannot claim the VAT exemption.
Nope, they are taxable.
Yeah.
And for medical services, hospital bills and dental clinics are exempt, sure. But there is a massive carved-out exception for professionals.
Right, so if I go to the hospital for surgery, the room, the anesthesia, the nurses, that's all exempt.
Correct.
But the surgeon who walks in performs the operation and bills me separately.
That surgeon's professional fee is subject to VAT.
Wow.
Yeah. The government exempts the institution to keep healthcare accessible, but they still want to tax the high-earning professionals operating within it.
That makes sense. Oh, and you also need to watch the dates on temporary exemptions. I know during the pandemic, the CREATE law and RA 11534 exempted COVID-19 drugs, vaccines, and PPE.
Yes, but that exemption had a strict expiration date.
Right.
It was valid from January 1st, 2021 to December 31st, 2023.
December 31st, 2023.
Right. So if an exam problem is set in 2022, those vaccines are exempt. But if the problem explicitly states the transaction happened in February 2024,
The exemption is dead.
the exemption is dead and the transaction is 12% taxable. The examiners are testing to see if you are paying attention to the temporal reality of the law. They love time traps.
They really do. Okay, so we've figured out what's taxable, what's zero, and what's exempt. We have our output tax.
Right.
Now we have to subtract our input tax to find the final VAT payable. Sections 110 and 111 govern input tax credits. And there is a structural update here regarding capital goods that is practically screaming to be tested.
Oh, this is probably the biggest update candidates need to watch out for.
Hmm.
Prior to 2022, purchasing heavy machinery was a total cash flow nightmare for businesses.
Because of the amortization.
Exactly.
Yeah.
If you bought a massive printing press for 5 million pesos, you obviously paid a huge amount of input VAT. But the old rule said if the acquisition cost of capital goods in a single month exceeded 1 million pesos, you couldn't claim all that input VAT immediately.
Even though you already paid it.
Right. You had to amortize it, meaning you had to drip feed it over 60 months, or the useful life of the asset, whichever was shorter.
So the government forced you to tie up millions of pesos in tax credits for 5 full years.
It was terrible for business growth.
But they killed that rule to stimulate the economy, right?
Exactly. To encourage capital investment post-pandemic, the amortization rule for capital goods ended on December 31st, 2021.
Okay, so this is a massive trap for candidates using outdated review materials.
Huge trap. If an exam problem is dated in 2022 or 2023, and a company buys a 10 million peso machine, do not divide the input tax by 60.
Just take it all.
Yes, you claim the entire input tax in the exact month of purchase.
But wait, what if a company bought a machine back in 2020 and they're still in the middle of that 5-year amortization period when 2022 rolls around? Do they just take the rest all at once?
Ah, good question. No. The law allows them to finish what they started.
Okay.
Unutilized input VAT from capital goods purchased before December 31st, 2021 continues to be amortized until it is fully utilized.
Oh, man. So you really, really have to look at the exact purchase date of the asset.
Purchase date is everything on those problems.
Okay, that's crucial. Now, aside from the actual input tax you pay on purchases, there are two, what I like to call phantom input taxes you can claim.
Transitional and presumptive.
Right. Let's tackle transitional first. This happens when a business finally crosses the 3 million peso threshold and becomes VAT registered for the very first time.
Right. When you register, you likely have a warehouse full of inventory that you bought when you were a non-VAT taxpayer.
So you couldn't claim input tax when you bought them.
Exactly. But now that you're registered, you are going to have to charge output VAT when you sell those same goods.
Which feels a bit unfair.
It does. So, to be fair, the government gives you a one-time transitional input tax credit on that beginning inventory.
And what's the formula?
It is 2% of the value of the inventory or the actual VAT paid on those goods, whichever is higher.
2% or actual, whichever is higher. Got it. But the really interesting one is the presumptive input tax under Section 111.
Oh, this one is very specific.
Yeah, it's a special 4% credit, but it only applies to very specific processing firms. Why does this even exist?
Well, think about what we said earlier about exempt goods. If you are a manufacturer and you buy raw agricultural products from a farmer, those goods are in their original state and are therefore exempt.
Right, so no VAT.
Which means you didn't pay any input VAT.
Sure.
But when you process those goods and sell them in a can or a bottle, you have to charge 12% output VAT.
Because it's processed now.
Right. And because you have zero input VAT to subtract from it, your tax bill would be enormous.
And you would just pass that massive cost straight on to the consumer.
Exactly. And the government doesn't want to cause massive inflation on essential survival foods.
Yeah.
So, to cushion the blow on the poor citizens, the government basically invents, they presume, an input tax of 4% of the gross value of the primary agricultural materials purchased.
But it is strictly limited to 5 specific industries, right?
Yes, only 5.
And here is the mnemonic to lock those 5 items into your brain for the exam. You listening, get your scratch paper ready. The acronym is SMMRC.
I love this one.
Yeah, I want you to imagine the most bizarre apocalyptic pantry in the world. It only has 5 things on the shelves: sardines, mackerel, milk, refined sugar, and cooking oil. SMMRC.
It is a weird pantry, but it works perfectly.
Right.
Processors of sardines, mackerel, milk, refined sugar, and cooking oil get the 4%. So if an exam question asks about a corned beef manufacturer, do they get the 4%?
No, corned beef isn't in the pantry.
Exactly. What about a brown sugar manufacturer?
No, because brown sugar is raw and exempt anyway, so there's no output tax problem to solve.
Perfect. It has to be refined sugar.
SMMRC. Literally write it in the margins of your scratch paper as soon as the exam starts.
Definitely do that.
Finally, if you do all this math and you end up with excess input tax lake, especially if you are a zero-rated exporter, what we talked about earlier, Section 112 outlines how to get your refund.
Yes, and the timelines here are strict.
What are we looking at?
A taxpayer has exactly 2 years after the close of the taxable quarter, when zero-rated sales were made, to apply for a tax credit certificate or a refund.
So you have a 2-year window to build your case and submit your receipts.
Exactly.
And once you submit, the BIR is on a ticking clock too, right?
A very fast one. The BIR has exactly 90 days from the date of submission of the complete documents to grant or deny the refund.
90 days. That's actually pretty quick.
It is. This 90-day rule was implemented because the government used to take years to process refunds, basically holding exporters' cash flow hostage.
Wow.
Yeah. So now, if the BIR denies it within those 90 days or simply fails to act, if they just ignore you, the taxpayer has 30 days to appeal to the Court of Tax Appeals.
Okay, we have traced the entire value chain today, from the basic liability rules all the way to appealing a refund at the tax court.
We covered a lot of ground.
We really did. So let's distill everything we've talked about into an exam day checklist. Here is your 4-point rapid-fire recap of absolute must-remembers. You ready?
Let's do it.
Number 1, if a non-resident foreign person renders a service in the Philippines, ignore the rule of regularity. They are liable for VAT even for a one-time gig to protect the local tax base.
Number 2, watch the clock on consignment. If consigned goods aren't sold within 60 days, they become a deemed sale on day 61, triggering output VAT immediately.
Day 61. Okay, number 3. Remember the bizarre pantry mnemonic for the 4% presumptive input tax? SMMRC sardines, mackerel, milk, refined sugar, and cooking oil.
And number 4, look closely at the purchase date of heavy machinery. If capital goods exceeding 1 million pesos were bought in 2022 or later, you claim the entire input VAT immediately. The 60-month amortization rule is dead.
Which actually leads us to a final thought for you to chew on, something that bridges your taxation review with your management advisory services review.
Oh, the MES crossover.
Yeah, because the death of that 60-month amortization rule isn't just a tax trivia fact.
It is a massive shift in corporate finance.
Yeah.
I mean, imagine you are a CFO evaluating whether to buy a 10 million peso piece of equipment.
Okay.
Before 2022, you had to drip feed that 1.2 million tax credit over 5 years. It dragged down your net present value.
It hurt your cash flow.
Exactly. But now you get that entire 1.2 million peso tax shield on day one. It fundamentally changes a company's immediate cash flow, their working capital strategy, and the math behind their capital budgeting decisions.
See, the subjects aren't isolated silos. They all connect.
They absolutely do.
And you have the ability to connect them. Keep grinding through those multiple choice questions, trust the logic behind the rules, and walk into that testing center knowing you are ready.
You've got this.
The VAT X-ray might look murky to everyone else, but you know exactly where the brakes are. Keep pushing, and we'll catch you on the next deep dive.